Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Jeff Kilburg, founder and CEO of KKM Financial, for an update on how earnings season is progressing. We'll also take a look at the impact of a higher U.S. dollar that does not seem to be moving lower at any point in the near future. But Jeff, let's kick it off and talk about earnings. How do you think the season has been progressing so far?
Well, Jill, earnings are better than expected, but that was an easy bar to get above because we typically see in earnings season the bar get lowered nearly about 4% on average. Well, this earnings season we saw the bar lowered across the board about 7.5%. So those expectations going into earnings season, like you just said, the weight and the strength of the dollar, we really thought was going to be more of a conversation, more of a forward guidance, but we are seeing a little bit better than expected. However, this is all in the face of boiling over interest rates. So when you talk about the earnings season, we had a nice cross section this week. Next weekend, we're going to get the mega technology stocks. We're really looking forward to that, but we also have some oil and energy. So next week, I know we're really getting into the heart of earnings season. It's going to really help us get a better understanding of how impactful that strength in the dollar you talked about, but what does it look like? Are companies still making money? And so far, Joe, the answer is yes. Some of these companies are really doing well. You look at a Lockheed Martin, it accelerated their buyback. So there's a couple components that I find some optimism in this earnings season.
Yeah, and we certainly saw that in the beginning of the week. We were able to string through a number of green sessions there. But Jeff, it just seems as if this market's being held hostage by headlines that are coming out of the Federal Reserve and the number of speakers that they have on the circuit. I didn't even realize that they had that many. And it just seems to be every day and multiple times during a trading session that you get some sort of headline that crosses with a Fed speaker making some sort of commentary on the direction that the Fed is taking. And you see how the market reacts to it.
It's remarkable to see how beholden we are to the microphone of the Fed presidents like you spoke about, but it's not even what the Fed may do. It's just a theory or what if scenario. So today we saw a what if that maybe they become a little bit more dovish via Fed President Daly. But at the end of the day, I think we are looking squarely at interest rates. We saw another 14-year high move in the 10-year note, that yield up to 4.25. The 2-year note, the front end of the curve, just dramatic to see it about 4.5% and still holding on. So we are going to continue to be in this predicament, Jill, until we see some form of U.S. Treasury relent, I guess is the word, in U.S. yields. But that's been so sensitive. If you look at the last month, what's interesting on a sector basis, you've seen utilities really fall out of favor, down 15% in the last month. Why? Well, all of a sudden there's an interest yield, there's some juice in the U.S. Treasury curve for the first time in a long time for investors to flock to. So we noted some institutional buyers in the futures market at that 4.5% yield in the 2-year. Maybe that will become more of a theme going into year end because people are now finding that the U.S. Treasury market is about 200 basis points more than the S&P 500 dividend yield.
Yeah, it's interesting. You're starting to hear a couple of strategists talk about opportunities in emerging markets because their valuations are quite incredible right now, and they are offering some yield as well. But it's really the U.S. dollar that is holding some of those positions back. We're also seeing it in the commodity space, how that impacts it as well. What do you think it would take for the dollar to come in just a bit? Is it again predicated on what we see happen with rate strategy?
I think it's a 1-2 punch, Jill. I think you're absolutely right. It's Fed policy here domestically, but it's also the retaliation, the recourse, the ramifications of this Fed policy. So we saw over in Japan, they intervened for the first time since 1998 when they pegged their currency about 2 weeks ago. Will we see more of that? I know there's been a lot of focus on the Bank of England and all the bond buying they're doing over there, but to put it in context, Jill, they bought about 15 billion with a B in that little intervention. We have 5.6 trillion with a T on our balance sheet of U.S. Treasury that the Fed has bought. So I think, yes, the heavy hand continues to be the Fed, but there is going to be some retaliation, currency war, if you will. And I think if that does bring down that dollar, then you will see the ability, putting the midterm elections in the rearview mirror, putting the rate normalization process in the rearview mirror. You could see some cautious optimism. And remember, Jill, as you remember from your days of volatility trading, volatility takes markets up easily in the same manner they take markets down.
Right. And that's a great point that you make because no one had a problem when there was so much liquidity being injected into the system. But things that do go up also do come back down to your point. But Jeff, what I thought was interesting was when we saw the resignation of the UK Prime Minister yesterday, the market didn't have that volatile of a reaction to that. And that is certainly a volatile event that can really, make the market go haywire. I just wonder if we have so many macro factors being thrown us at once that it's discounted, it's in there. We know that there's a lot of headwinds right now, and it just didn't feel like the reaction was so severe as it might have been if that was the only outlier.
I don't think it was the biggest reaction, and this isn't diminished. I'm going to get in trouble with some of my friends across the pond, but it wasn't that big a deal. That impact, that intervention, like I talked about, in context compared to the U.S. Treasury market and what the Fed has done, it pales in comparison. So it didn't have that effect, but I think that all the macro headwinds are kind of coming to a head. But it's remarkable to see, Jill. We put in an S&P 500 low a couple weeks ago, and in the face of all these macro headlines, we talk about Russia, we talk about the Ukraine war continue to persist, we talk about the SPR, we talk about all the political components out there. We are still seeing the market finding a way to recover and potentially put in a bottom for 2022. And I think if we can get 2-3 weeks further out of earnings season with some positivity, and also with the midterm elections behind us, I think the catalyst of selling the market, the reason to sell the markets, they tend to fade away, and that's when you see the narrative flip. And I'm looking at 4,100 specifically in the S&P 500. If we can get back there, that's the line in the sand. That's where we fell from last time technically. If we can get above there, a lot of shorts will be caught off sides. A lot of people will be underinvested, and that's the volatile event I'm talking about going to the end of the year that could take us up another 5 to 7% just because it got above that line 4,100 in the S&P 500 from a technical perspective.
All right, Jeff, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.